This is Nightly Business Report with Tyler Matheson and Sue Herrera.
Oil slick. Profits from some big energy companies hit a decade low. And with crude prices still declining, are their dividends safe? Payday, but not the kind many would like, as wage growth hits a record low. And the big idea, meet the kids who want to create the next hot startup at summer camp. All that and more tonight on Nightly Business Report for Friday, July 31st. Good evening, everyone. Tyler is off tonight. Big oil profits slammed. ExxonMobil and Chevron posted their worst quarterly results of the current decade as two of the biggest oil companies in the world showed investors just how much of a toll crumbling crude prices are having on their bottom lines. Chevron's earnings dropped 90% from a year ago. Exxon's earnings were cut in half. And these two Dow components saw their stock prices take a hit. Chevron was off nearly 5%. Exxon sank 4.5%. And today, crude prices continued their tumble, settling down nearly 3% to $47.12. The commodity is now down 21% this month, its worst month since October of 2008. And that was the heart of the financial crisis. Jackie DeAngelis has more now on the pain in the oil patch.
When big oil speaks, investors listen, but what was said today was not encouraging. ExxonMobil reporting its worst quarterly profit in nearly 13 years, and Chevron seeing its profits plunge, triggered by impairments and charges based on lower oil prices. Exxon noted that higher profit in refining couldn't offset losses in its upstream businesses. That's the exploration and production side of things. Exxon making a move to conserve cash, a sign to the market that it doesn't expect to see a quick rebound in crude prices. The company planning to scale back share buybacks by half, quarter on quarter. And Chevron, which stopped working on projects because it didn't see a rebound in prices, was forced to take a multi-billion-dollar charge. CEO John Watson saying, second quarter financial results were weak, reflecting a crude price decline of nearly 50% from a year ago, and that his upstream businesses were particularly hard hit.
What Big Oil is telling us is that they still believe the market will be going lower. There's no question that they are not happy with what's happening, and their profits are showing it.
Cost cuts continue. Chevron and Exxon both cut spending by about $1 billion from a year ago. Both stocks hitting multi-year lows today, and year-to-date, both suffering double-digit declines. So the next question is, what does this mean for oil prices?
The trend right now seems to be down. I still believe there's going to be a point where, at this point, the consumption is going to increase. Everyone's going to now suddenly take another look and see that these prices are ridiculously low, and that maybe now we've stopped that downward slide.
Others tell me they're eyeing this year's low of 43.46 as a key resistance. And if we breach that, maybe a 3 handle that we saw in 2009 is next. For Nightly Business Report, I'm Jackie DeAngelis.
With the decline in oil prices and the disappointing earnings from big oil this quarter, many investors may be wondering whether the dividends paid by these companies are safe. Bob Pisani reports from the New York Stock Exchange.
Looking for a big dividend yield? The oil majors are trying to convince you that they're the place you want to go. Today, ExxonMobil and Chevron reported earnings which were disappointing, to say the least. One thing they did not disappoint on was the dividend. Both affirmed they would continue to pay the current dividend, and that's part of a trend. ConocoPhillips and Royal Dutch both said yesterday their dividends were safe and the yields are really juicy. Royal Dutch, for example, has a 5.8% yield, as does Conoco. Chevron has a 4.8% yield. Pretty good considering the S&P 500 only has a yield of 2%. And they're going out of their way to assure you that the dividend is not going to be cut. Conoco CEO Ryan Lance opened his conference call with the statement, "The dividend is safe. Let me repeat, the dividend is safe." Get the point? You think the dividend is safe here? You can't blame them, really. It's part of a desperate effort to remain relevant to investors. If your profits are down, then boost the dividend and say it's safe. There's legions of yield-hungry investors who will sit up and pay attention to that. That's right, big oil like a utility play. Now, are the yields safe? That's the issue. For the moment, yes, big oil can afford to fund the dividend from the cash balance, and they also have access to the capital markets that they can tap as well. But in the long run, and I'm talking a couple years, they all need oil to be higher. You cannot forever just sell yourself as a utility play. And that's the main objection that the traditional energy investors have to the big oil as a utility play. Well, I might get a juicy yield, that's nice, but if the stock price keeps dropping, I can still lose money. The argument is that we are near the bottom of this terrible cycle, or at least that's what the big oil companies are hoping. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
Drivers may be paying less for gas over the coming months. According to GasBuddy, which tracks trends at the pump, prices could reach $2 per gallon by the new year. Some of the reasons include a possible easing of sanctions against Iran and a slowing Chinese economy. The oil majors weighed on stocks on this final day of trading for the month of July, pulling the Dow Jones Industrial Average lower. The blue chip Dow Index dropped 56 points to 17,689. The Nasdaq fell half a point, and the S&P 500 lost 5. For the month of July, which was marked by the debt crisis in Greece and the plunge in Chinese stocks, well, stocks actually fared pretty well. The Nasdaq and the S&P 500 saw gains of at least 2%, and the Dow ended the month fractionally higher. But as Dominic Chu reports, attention now turns to what may happen in the next 6 weeks leading up to that critical meeting of the Federal Reserve.
After all the ups and downs, July has closed out with gains for many stock market investors. But the weeks and months ahead could be ripe with even more volatility as traders keep a close eye on a slew of potential upside or downside catalysts. And the origins of these market-moving events come via both macro or bigger picture economic trends, as well as micro or more industry-specific and company-specific stories. Both will have a big influence on how stocks trade here in the U.S.
But there is a lot of evidence that at least in the short term, stocks are trading based on earnings. The all-important monthly employment report comes up next Friday. And then, of course, there's international economic conditions. We'd be remiss not to mention China, and what does that mean for stocks?
There are a few things to keep in mind as these stories begin to unfold. On the earnings front, we're in the waning part of reporting season. And if all remaining companies in the S&P 500 report as expected, we could see modest earnings growth, but revenue declines over the same time last year. But some experts are keeping a close eye on potential catalysts that could help power the market even higher.
The real big thing that could happen is a decline in the dollar. If you look at the earnings reports for the second quarter, first quarter and second quarter, they've been inhibited by a very strong dollar. If the dollar declines, and I think there's a strong case that could be made for a dollar decline, then prospects for earnings are going to get much brighter, and that's going to touch off a rally in the stock market.
August has generally been a weaker month for the U.S. stock market over the past 20 years or so. And with many Wall Street professionals still on vacation, lightly traded markets could produce some more stock swings. For Nightly Business Report, I'm Dominic Chu.
Wages grew at their slowest pace since 1982. The Employment Cost Index, which tallies wages, salaries, and benefits, rose just 0.2% in the April to June period. That rate is the slowest since records began in the early 1980s, and it follows a 0.7% increase in the first quarter. As we've been reporting, the Federal Reserve wants wages to rise in order to bring inflation closer to its 2% target. Bricklin Dwyer says weakness in wage growth will likely raise more doubts about the Fed and the strength of the economy and increases the chances of a December rate hike. He is senior economist at BNP Paribas, and he joins us this evening. Good to see you, Bricklin. Welcome.
Hi, thanks for having me.
I guess one of the better questions is, given the fact that the economy is in recovery mode and we've seen advances in a lot of key indices, why haven't we seen upside wage pressure yet?
Well, you know, this last recession really took a toll on people and has really hampered their ability to feel confident that when they sit down with their boss, they can ask for just that much more in terms of their pay. So I think that time right now is upon us, but we're not there yet. That's what the data is telling us now. So
are you concerned, or do you think that as the data continues to improve, we actually will see people more empowered to ask for raises and put some pressure on businesses to increase wages?
Well, like most people, we looked at the data today and we're quite shocked at the weakness. That being said, with Q1 so strong, it kind of offsets that and puts us back on the trend. And wages are roughly growing at the same pace of where they were at the end of last year. So what that means is wages aren't really accelerating right now, but they're not decelerating either. So in our view, you know, we're kind of back to where we were. We were hoping we're a bit further along, and we're not quite there yet. We're optimistic that we're going to get there later this year.
What does it say, though, about businesses and about the economy?
I think right now, businesses just aren't getting that pressure from their workers who, aren't showing up and banging on the door and asking for more money yet. Right now, they're getting that bang on the door from their shareholders asking for their money back. So, it's a competition. You got to compete for that money. And right now, those workers just aren't feeling that confident yet.
What about productivity?
So productivity has been particularly weak in this recovery, and we just haven't seen that acceleration yet that you'd normally see. And so businesses are looking at productivity as a trade-off between either paying people more or hiring more workers. And with low productivity, they're going to hire more workers rather than pay people more.
Are you overall optimistic, though, that we will see the Fed carry through with what it seems to be promising, and that is a rate hike before the end of the year?
I think they're telegraphing that fairly confidently right now. Data will certainly be the devil in the details there. But we expect employment to really be the foretelling indicator right now for the U.S., which we expect to be fairly firm in the coming months.
All right.
That'll really set the tone.
Bricklin, thanks so much. Have a good weekend.
All right, you too.
Bricklin Dwyer with BNP Paribas. And still ahead, the stocks that our market monitor says are cheap and belong in your portfolio for the long haul. He'll name some names for us coming up next. CVS Health is being accused of overcharging pharmacy customers. According to a complaint filed in San Francisco, CVS intentionally overcharged for generic prescription drugs by submitting claims for payment to third parties at inflated prices. The plaintiffs are seeking class action status, but a similar federal complaint was dismissed in Massachusetts. General Electric is echoing the recent comments from Boeing. GE reportedly says it may send $10 billion worth of work overseas now that the Export-Import Bank will be shuttered until at least September. According to Reuters, the company is working with export credit agencies in other countries to help finance some deals. The countries that could get that manufacturing work from GE include Canada, the UK, France, Germany, China, and Hungary. A new chapter for JCPenney. The department store will get its third CEO in 4 years this weekend. And during the past 4 years, the stock has plummeted, losing more than 70% of its value. Courtney Reagan takes a look at what the new boss is inheriting and what he needs to do to get cash registers ringing again.
Tomorrow, JCPenney gets its third CEO in 4 years. Marvin Ellison has been working side by side with outgoing CEO Mike Ullman for the past 10 months as president, CEO designee, and JCPenney board member. JCPenney's way of ensuring a smooth transition after Ron Johnson was pushed out and Mike Ullman returned to stabilize the retailer. Prior to JCPenney, Marvin Ellison spent 12 years at Home Depot and 15 years at Target. Most of his experience is in operations and logistics, causing some concern about his lack of merchandise experience, particularly in apparel. But others believe that Ellison brings a fresh perspective to JCPenney and that he understands the customers and the employees. His mother shopped at JCPenney for him and his siblings growing up, and he started out as a part-time employee at Target.
This journey for him is not just professional, it's absolutely personal. And we think it's that authenticity that's going to drive his authority, not only with his customer, but also with his associates.
While Ellison and outgoing CEO Ullman crafted the current back-to-school and upcoming holiday strategies together, Ellison is inheriting a fragile retailer. At its peak in 2003, JCPenney generated $32.3 billion in annual sales. Now, revenues are less than half that. Deutsche Bank analyst Paul Trussell says Ellison's first task is to maintain current momentum and then step it up, improving profitability and free cash flow, which has proven to be difficult. But most who have met Ellison come away optimistic.
You have to know what your customer wants. You have to understand what it is that she needs. That's both from a product perspective as well as a value. That's what JCPenney is riding the ship on right now. And so we believe they have a much higher chance of converting as that traffic actually shows up for back to school and into holiday.
As for making strategic changes at the retailer right away, Ellison tells me change for the sake of change is overrated. But some shifts may take place next year. For Nightly Business Report, I'm Courtney Reagan in Daly City, California.
Royal Caribbean cruises higher on an earnings beat, and that's where we begin tonight's market focus. Profits topped estimates while revenue was slightly below forecasts. The firm raised its full-year profit forecast on a cruise booking surge in the Caribbean and success in the fast-growing Chinese market. Shares popped 8.5% to $89.85. Weyerhaeuser's bottom line results topped estimates, but earnings fell more than 50% from the previous year. The firm, which produces lumber, was hurt by the delayed arrival of the spring home selling season and the stronger U.S. dollar. Still, the stock was a fraction higher to $30.69. Newell Rubbermaid bumped up its guidance for the full year after reporting an increase in quarterly revenue and a beat on the bottom line. The firm, which makes Sharpie pens and Calphalon cookware, saw growth in its baby and school products divisions. Shares were 1% higher to $43.28. And investors getting a chance to react to disappointing results from Hanes Brands. The apparel maker's sales and earnings didn't meet Wall Street expectations, and on that, the company lowered its full-year revenue guidance. Shares tumbled a full 9% to $31.03. And now to our market monitor, who likes large-cap stocks that he says are cheap and misunderstood by investors. This is his first time joining us on the program. He is Charles de Reyes. He's a senior analyst at Brandywine Global. Welcome, Charlie. Nice to have you here.
Hi, thanks for having me.
So what is it that you like about, before we get to your picks, about the large cap stocks in particular?
Well, we see, when we're looking across the large cap universe, we're finding pockets of some extraordinary cheapness across the valuation space. And so not all large caps are cheap, but we found enough opportunities where we think we can really add some profit for our clients.
What do you expect as we start a new month of trading and we edge closer towards the September arena, where a lot of people do think that the Fed will move up on rates?
Sure. Well, first off, August trading is usually always pretty volatile. Mm-hmm. You have a lot of investors going on vacation, so the trading tends to be kind of sloppy leading into that. We take a viewpoint that, the Fed is going to wait for definitive data on whether or not to raise rates, and most of that's going to be predicated upon the jobs report.
All right, let's get to your picks. The first one up is Citigroup, target price of about 75 over the next 12 to 18 months. Why do you like it?
Well, we like Citigroup because we think, number one, it's an extraordinarily cheap stock. The bank is very well capitalized, and we think next year they could start to return capital back to shareholders and take up the dividend. But more importantly, we think the actual earnings of the company are depressed right now, and that's due to the low interest rate environment, which is pushing revenues down. So we think, looking out 2 years, Citigroup could earn $7, and a lot of that will be predicated on the interest rates. But most of that's actually on cost cuts. So we like Citigroup a lot right here. Yeah, and it's more of an international play versus the next financial that you like, which is Bank of America, which is a much more domestically focused bank. Right. Yeah. Bank of America similarly is very cheap, and we think investors aren't giving it credit for a lot of the cost cuts that the bank has done. And just like Citigroup as well, the interest rates are pushing the revenues down, which is masking the true earnings power of this company. And so we think the combination, looking out 2 years, Bank of America could be earning $2 a share, and we think that's not being priced into the stock right here. And finally, General Motors, you say that people are maybe overreacting a little bit to what's going on in China. Sure. So General Motors stock, it's one of the cheapest that we find within the entire market, and especially the large cap universe. Investors are really nervous that the Chinese auto market is deteriorating. But when you actually look at GM's results over the past 2 quarters, that hasn't shown up yet, and it's not evident in their results. And GM's not getting a lot of credit for the strength of the North American business, which just put up its best quarterly profit of all time. And additionally, GM, their European business and the Latin American business are losing money today. But within 2 years, both of those businesses could be back to break even. And GM also pays a 4.5% dividend yield. So there's a lot to like with GM, and there's a lot of ways to really win with that stock.
All right. On that note, Charlie, thank you very much for joining us tonight. Charlie DeReyes
Thank you for having me.
Brandywine Global. And coming up, forget soccer camp. Meet the kids spending their summer creating business plans. And here's what to watch for next week. More earnings, including results from Dow component Disney. Lots of data, including personal income and spending, international trade numbers, and also auto sales. And Friday is the big one, the jobs day. The monthly employment report is out. And that is what to watch for next week. Well, move over, Greece. Puerto Rico is back in the hot seat. The Commonwealth needs to make a $58 million debt payment Sunday, but top officials say they don't have the money. This could end up becoming the start of one of the biggest municipal restructurings, with the potential to spark fights with investors and create volatility in bond prices. And there is a crisis developing across the ocean. Thousands of vehicles and delivery trucks are stuck along one of Britain's main highways, causing food to rot and goods packed for European destinations to sit. And it's starting to take a toll on the British economy. Hadley Gamble explains what's happening from Ashford in the United Kingdom.
They call it Operation Stack. Over 5,000 container trucks lining one of Britain's major motorways, all caught up in a massive security bottleneck that British authorities say shows no sign of letting up. You see these thousands of trucks lined up behind me, unable to get their goods to market in European ports. And essentially that is taking a hit not just for the trucking services themselves, but also for the UK economy. There are estimates that the UK economy is losing up to £250 million per day, and that these truck companies themselves are losing something like £750,000 per day. It's just the latest fallout from the continent's migrant crisis, as thousands of asylum seekers from countries like Syria, Libya, Sudan, Iraq, and Afghanistan try to find a better life. Over 4,000 migrants are currently camped out around Calais, and more than 100 arrive every day, all of them hoping to hitch a ride to the UK just 21 miles away. And all of that adding up to a security and logistics nightmare for British and French authorities that's now putting a major strain on British business. Police say they've already spent around £1 million on the Channel crisis, and the government now says they'll be shelling out an additional £7 million to tackle the problem.
We've invested money in the fencing around Calais. We're also putting fencing around the entrance to the tunnel at Coquelles. So we're doing everything we can.
But all that cash won't be enough to solve things short term. Authorities expect Operation Stack to continue through the weekend. And government officials admit the long-term solution for asylum seekers will have to begin back at home. For Nightly Business Report, I'm Hadley Gamble.
A huge advancement in the fight against Ebola. Merck and New Links Genetics' Ebola vaccine was 100% effective in preventing that disease. That's according to a late-stage study in Guinea. The results still need to be confirmed, but the World Health Organization is calling the news an extremely promising development. Uber, the ride-sharing company, has reached a valuation of nearly $51 billion after its most recent round of funding. That's according to the Wall Street Journal. That valuation would top the market capitalization of more than 80% of the companies in the S&P 500, and it would make the 5-year-old firm as large as General Motors. And finally tonight, when most kids are at camp playing baseball or swimming, others are learning how to be entrepreneurs. Kate Rogers introduces us to the kids who may one day develop the next hot startup.
I'm Karina Dani, and our product is a Pamper Hamper.
It may be the dog days of summer, but these kids are working harder than ever at Explo Startup, based at Wellesley College outside of Boston. It's a 2-week intensive program to help kids with big ideas learn to network, pitch investors, market, and more.
That's perfect. Nice work.
This year's class has attendees from Hong Kong and Dubai, as well as the United States. The program's selective, and kids have to apply to get in.
We're letting them be kids, but they're also cooperating and collaborating together. They're meeting speakers from industry. They're going to places like Google and Forrester Labs. They're learning about innovation. They're learning to write business plans. They're learning to pitch their ideas.
I just love that I will be in control and that I can have my own company.
It sounds really fun. You get a lot of freedom and money.
Explo itself has a wide array of program offerings, and past attendees include Kevin Systrom of Instagram and Jay Kaplan of Synack. Jonah Peretti, co-founder of BuzzFeed, was a counselor at Explo, and in total, 12 former attendees have made various Forbes 30 Under 30 lists this year. One of Explo Startup's more recent success stories is a student named Grant Goodman, who came to them last summer at age 14, having just launched his software company, Maxter Software Incorporated. Now at age 15, Grant's won not one, but 2 scholarships from Apple to attend their Worldwide Developers Conference, and he also has 5 apps available in the iOS store.
At the time, I had already started my own company, and I had already done a bunch of application stuff, but I wasn't really too keen on knowing anything about business. When I got in, that's what really pulled me in, being able to learn how to do business and learn how to pitch to angel investors and get VC money so I could further advance my own company that I had founded the year previous.
It's a sign of the times when kids tell you they want to become the next Mark Zuckerberg and not the next LeBron James. For Nightly Business Report in Boston, I'm Kate Rogers.
They're going to change the world. That's Nightly Business Report for tonight. I'm Sue Herrera. Thanks for watching. Have a great weekend, everybody, and we'll see you back here on Monday.